credit is starting to raise the alarm bells, okay? These are not times to be taking risk in levered financial institutions. I'm warning bank stock shareholders here as much as depositors, okay? There's $10 trillion of bank stock market cap globally that literally could get vaporized. You need to be invested in smart, sound money assets, which include Bitcoin and include gold.
Hey guys, welcome back to Let's Talk Crypto. Greg Foss is a bond and credit expert who has spent the last 30 years in high-yield credit trading and analysis as a managing partner of credit strategies. Foss has been adamant in warning about the debt spiral and certain fiat debasement, which is why he is a self-proclaimed Bitcoin enthusiast. In a recent interview with Kitco News, Foss shared his outlook on the macroeconomic conditions for the US and sounded the alarm about the banking crisis. Foss believes that the contagion effect will cause more banks to fail, eventually wiping out $10 trillion from the system as they all come down. When considering bank stocks, investors shouldn't focus solely on dividend returns. Instead, they should assess the risks of a bank failure. He warns that this is not the time for investors to take risks on banks. Instead, they should focus on hard money assets such as Bitcoin and gold. Early this month, Treasury Secretary Janet Yellen warned that the US could run out of money by June 1st, risking a default without an increase in the debt ceiling. This comes as no surprise to Foss, who has been warning about the possibility of a US debt default for a long time. Nevertheless, Foss argues that the US will be the last one to fail, as we can simply print more money. Let's listen to Greg Foss as he shares his insights on the economic landscape and the banking crisis risks of contagion that could be cataclysmic. But before we do, please consider subscribing to our channel, as we bring you daily content on the latest crypto news. And now, let's jump right into the video.
Banking is a risky business, Michelle. Everybody assumes that banks are too big to fail, and largely the biggest banks are too big to fail, which means they will get bailed out. But it doesn't mean that shareholders get bailed out, and this is where a lot of money can be lost, okay? There are probably, by my estimation, at least $10 trillion of bank equity globally. They can literally be wiped out if the system fails. It doesn't mean depositors don't get made whole, but in the case of Cyprus, they had bank bail-ins, right? This is another reason why you have to be very careful. A bank bail-in basically means depositors got a haircut as well. So this is the risky nature of banking. Just because you're JP Morgan doesn't mean you use a different formula for banking. The JP Morgan has capital ratios which are similar to these other banks. Perhaps JP Morgan managed their interest rate risk better and hedged it more properly. But look, you can look at the available for sale securities and the mark-to-market losses that are on Bank of America balance sheet, and you're blown away. You're like, oh my God, that would vaporize the lion's share of their equity as well if they had to sell or mark-to-market that portfolio. So at the end of the day, banking is banking. There will be more failures. Will they be cataclysmic failures? That's the difference. Contagion, where the system breaks down. Possibly. My hope is no. But I'm telling you, you saw Credit Suisse fail, and Credit Suisse largely failed because of initial butterfly wings over in America. But listen, a few more failures in regional banks in America, and all of a sudden Deutsche Bank is on the ropes. And Deutsche Bank is way more levered than Credit Suisse was. Its derivatives book, which is off balance sheet, is way larger. And Deutsche Bank is a globally systemically important bank called a GSIB. And this will not be allowed to fail outright. It doesn't mean the shareholders won't get wiped out exactly the way Credit Suisse shareholders did. So these are the type of contagion events that slowly then suddenly the system breaks because of the leverage in the system. A bank bail-in would cause the entire system to collapse, in my opinion, okay? You can do it in a small country like Cyprus, but try and do it in a G7 country, let alone the United States of America, the G1 country of the world. It would be cataclysmic. So I'll just tell you, I'm warning bank stock shareholders here as much as depositors, okay? Again, there's $10 trillion of bank stock market cap globally that literally could get vaporized. And that's the size of the gold market. And that's 20 times the size of the Bitcoin market cap that still lives in bank stocks that I think are mispriced relative to their risk. So, let's not go all the way down to the depositors. Let's focus on these equity guys. Contagion will bring them all down.
Okay.
Because here's the thing, again, JP Morgan is way too big to fail, but their bank stock can also go down an awful lot. And that's the key, right? Failure doesn't mean protecting the shareholder. Failure means they will protect the deposit holder or the lender, because when you give a deposit to a bank, you're effectively lending your money to the bank, but they will not protect the shareholder. You saw this in the case of Credit Suisse, where they had this bond called a COCO bond, a contingent convertible bond, or an AT1, alternative tier 1 bond. They got zeroed out, absolutely zero recovery on the bond, and they forced through some residual equity value. This is just rewriting the rules of finance in order to merge the banks under a very stressful scenario. So, look, here's what I would say. Please don't own a bank stock because you think it's got a attractive dividend. That is not the way to look at a bank stock. The stock prices can go far lower, much like they did in the LDC debt crisis, and much like they did in the 2008-2009 great financial crisis, both of which I lived through. These are not times to be taking risk in levered financial institutions, in my opinion. Credit is starting to raise the alarm bells, okay? Yes, a recession, how severe will depend upon how long the Fed holds on to their failed policy of lower for longer, now higher for longer. They always hold on too long. I don't make forecasts. What I do know for sure is I am 100% certain that fiat will debase in all scenarios. Okay? Fiat will debase. I'm 100% certain because that's only mathematics. We have a deficit in the United States, I say we, has a deficit running. So the annual deficit is running at 7% of GDP. And the total accumulated debt is over 120% of GDP, which means next year it'll be 127% of GDP and then 134% of GDP. The only escape, the only way to solve that debt spiral is by printing more money. And when you print more money, fiat debases. And when fiat debases, soft assets lose their value, like bonds. Even if you get your money back, you lend the government $100 for 10 years, you get your $100 back in 10 years with a series of coupons. That $100 is worth $65 equivalent from time zero. This is not a sound investment. You need to be invested in smart, sound money assets, which include Bitcoin and include gold. I don't try and make forecasts. All I know, when someone tells me or shows me something with 100% certainty, which is fiat debasement because of the debt spiral, I take measures into my own hands to protect myself and buy hard assets. Here's the truth. If the USA could not print money to solve their debt burden, they'd be the equivalent of a CCC rated corporation, because the USA does not even cover its interest expense one turn from its EBITDA, if you will, or free cash flow. Why? Because the USA has entitlement spending and it has military spending, and the residual is not enough to pay for the interest expense. So the USA is a zombie borrower, but it can print money. There is a credit default swap market that prices the probability of default of the USA. It's not zero because of things like potentially a failing country, but it still is very minute compared to the risk of corporate credits in the CCC realm, the zombie company realm. Nonetheless, you can look at Bitcoin as being insurance on the failure of a basket of fiat currencies, a basket of sovereign debt. $3.2 trillion would be the implied insurance value on the United States. $3.2 trillion just on the United States. What is Bitcoin trading for? Well, about $500 billion. Oh my God. If people embrace the thesis that Bitcoin could be viewed as credit default swap insurance on USA and all other countries, well, it's trading about 1/7 of its value just for the USA. And here's the really cool thing. There's no counterparty risk. Bitcoin is not an insurance company. When you hold it in self-custody, you don't have to worry about buying this insurance from an insurance company like Bear Stearns. See, when I was trading credit default swaps, I had an exposure to Bear Stearns that meant I thought I was going to have insurance from Bear Stearns. And guess what? When Bear Stearns looked like it was going to fail, I had to run out and buy insurance on my insurance company. You see how this whole circular thing works? Bitcoin is so beautiful because there's no counterparty. So there's a way to value it, and there's a way to appreciate that it has no counterparty risk. And then you could say to me, well, Greg, isn't the same thing said about gold? And I'd go, yes and no, because gold has no fixed supply. It's not transferable or portable like Bitcoin is. And most importantly, it's not auditable. There is no blockchain to audit it. And I still like gold, don't get me wrong. But at the end of the day, Bitcoin is so superior as not only a technology, but also as an auditable asset. That is why I love Bitcoin, as effectively, in my view, from a credit trader's perspective, my whole life, it is the most beautiful insurance policy on the failure of fiats globally. The USA will be the last one to fail, Michelle. The USA will be the last fiat to fail, but there's 150 other fiats that will fail before the USA, and that's why it's valuable to places like Argentina.
Foss is certain that fiat currencies will debase in all scenarios because of the debt spiral, so he recommends that investors take measures to protect themselves by buying hard assets such as Bitcoin and gold. What do you think of Foss's view on the contagion risk of the banking crisis? Let us know in the comments below. If you enjoyed this video, please make sure to give us a like and subscribe. Thank you so much for watching. This is Let's Talk Crypto, and we'll see you in the next video.